Hello and welcome to the Westpac Macro video. I'm Sean Callow and joining me today, Senior Economist Matthew Hassan. Welcome, Matt.
Morning.
Good to see you again. Yeah. Now, the housing market, always a very hot topic in Australia and around the world. Certainly we've seen a lot of upward pressure there. A lot of these stories are similar about the heat of the housing market since the pandemic, really, and to an extent a bit surprising, the scope of the strength given the huge hit to the economy. Now, recently you tweaked your house price forecasts for Australia for this year and next. Can you maybe just reiterate your current expectation of house prices, and in your note this week, the first reason that you think it's not just onwards and upwards?
Yeah, look, we have been pretty surprised at the speed with which the upturns come through. Late last year, we shifted our view to one of strong price gains this year and next, and it's coming through very quickly. The first quarter of this year, prices already look to be up at over 6%, probably close to 8%.
Amazing.
Once we get to the April number and next week. Part of the reason that'll come off a bit is that we got caught short last year. Basically, I think sellers decided to can planned sales last year and pack things up for next year. But demand came in really strongly at the back end of last year. So the market's been caught short on supply. We are seeing sellers starting to catch up. They're starting to catch up with very rampant demand, but we think that catch-up rebalancing will take some of the heat out over the course of this year. So that's really the main thing for the here and now.
Okay, so the supply wasn't ready for that increase in demand yet, so it takes a while. So that was your number one of the 4 reasons why Australia's housing boom will run out of steam. And so number 2, affordability?
Well, this is really going to be the main one this year.
Okay,
So the speed with which prices have rebounded, particularly in the Sydney market, means we're going to run into the affordability problems that we saw in 2015, 2017. And that those stretched affordability levels 5 or 6 years ago saw a clear drop-off in owner-occupier demand. They're very sensitive to affordability. On our reckoning, once prices are up a cumulative 15% or so, we start to get really back to that very stretched affordability level. So we think over the course of this year, that will really start to bite. We're already seeing the first signs of it happen around sentiment. So our consumer sentiment survey has a question on whether now's a good time to buy a dwelling. And that we know is very closely linked to affordability, both in terms of interest rate changes but also price moves. And that index is now nearly 20% below its November peak.
Right.
It sort of dropped into negative. We saw the exact same thing in 2015 to 2017 in the Sydney and Melbourne markets, and that was 3 to 6 months ahead of a sharp drop-off in owner-occupier demand. At that time, the market kept going, and we think it will keep going again this time, but that will come with a switch more towards investor-driven activity, which sort of brings us to the third reason of the 4, that as investor activity picks up from very low levels, the combination of a more active investor lifting strong growth in prices and a lift in credit growth, we think will be too much for regulators. Their tolerance at the moment is pretty good. They don't mind what they're seeing. But I think in about 12 months' time, they'll be more uneasy and they'll be concerned about any signs whatsoever of riskier lending, borrowing and lending decisions happening. We think that's going to bring a prudential policy response by about the middle of next year.
What form would that take, Pat?
It'll depend a little bit on the complexion of the cycle over the next 12 months. It may be that as we saw in 2015 and 2017, there may be a cap on credit growth for particular lines, so investor credit growth. It may be a cap on particular loan types. If we get a surge in high LVR or high debt-to-income loans, or as we saw back in 2017, interest-only loans, they may look to cap that. Or they may even tweak some of the prudential policy guidelines. So the guidelines around minimum floor rates are used in serviceability assessments.
Okay.
So it depends a little bit on the complexion of the market. Sort of coming back to my previous point about affordability, those measures in 2015 to 2017 mean that there's more inbuilt mechanisms around affordability, that those serviceability assessments got tidied up by the regulator through that last process. And so ultimately a lot of these decisions come back to incomes. And so if prices run too far, then it's harder to
incomes aren't growing much, are they?
Exactly. So that'll be more of a binding constraint on some borrowers that'll work through. But that macroprudential piece, we think for now it's off the table.
Yep.
Until we get this recovery really bedded down, and remember we're shooting for above trend growth and really hitting those targets for the RBA before they even consider a rate hike.
Yeah.
I think they'll look for that to be completely assured before they do any of this movement around macroprudential.
Okay, so the macroprudential really a story for 2022.
Yeah.
And so is that essentially one of the key reasons why you've gone from sort of a 10 and 10 prices to a 15.5-ish?
That's right.
Yeah.
So we always had a macroprudential response in mind in that 20% cumulative price gain. We think the combination, what we're seeing now is a stronger, faster rebound. It means we hit those affordability issues sooner. It probably means we get into macroprudential territory a bit earlier. We still see that 20% as really, that the cumulative gain overall is where we really get into tricky territory with affordability.
Yeah. Okay. All right. And so number 4 in the reasons why they won't continue forever. So the supply. Now this is a huge one for Australia. They're very volatile, really, aren't these swings in construction?
That's right. And right now we're getting a very strong lift in construction, supercharged by the home builder support scheme as well.
The government support,
and it's what's happening on the demand side that's important here. Now this is really, we see this as a potential impact on the market in the back end of next year. It's not something that it's not a central case here, but basically with a closed external border, our population-driven requirements for new dwellings are running at about 80,000 a year, and that's on the assumption that we do reopen in 2022 gradually.
Right, yep.
So 80,000 a year is a lot lower than we used to building. Prior to COVID, it'd be closer to 180,000.
Big difference.
And given this, we've had a lot of swings and roundabouts with dwelling construction, but where we're sitting at the moment with approvals, we're likely to be building about 180,000 new dwellings over the next year. So we're well ahead of that 80,000. Now, why we're not too concerned right now is that we think we're coming into this position with an accumulated deficiency of stock.
Okay.
That we had very strong population growth for an extended period, and outside of the Sydney, Melbourne high-rise construction cycle, construction everywhere else was pretty subdued and hasn't really been keeping pace. So we think there's a catch-up that's happening initially.
Okay.
But what that means is the longer that our borders stay closed and migration stays basically nil or slightly negative, the more we run into potential oversupply problems down the track. Now, that could manifest in strange ways. It's not often that you get an oversupply in a hot market. So it might manifest in things like a persistently high or rising rental vacancy rates. Not necessarily a huge sort of, at the moment when you've got on-market demand being supported by low interest rates running strongly, it should be able to absorb whatever supply is coming on. But if we accumulate too much housing stock, then we could lead to more meaningful problems in a year and a half's time.
Okay. And just briefly to finish up, have we still got a bit of that imbalance, the sort of pandemic demand for house with a backyard and your pandemic puppy to run around in, and so this demand for established detached dwellings versus high rise?
Absolutely. So it's rebalancing a little bit. I think the thing that's really clear in the first quarter of this year is the strength is across the board. Okay. Even if you sort of pick out the sub-markets that you would think are still struggling, so whether it's inner city, high-rise in Melbourne, some of the high-rise dominated sectors of Sydney, even those sub-markets overall are seeing price growth, which is quite surprising given some very high vacancy rates in those markets. So I think, of course you've got all these different shifts going on. You've got regions going strongly for the first time in a long time, and smaller capital cities also sort of leading the charge. But at the moment, the Sydney market's the one that's really fired up in a spectacular way in the first quarter of this year. So I think there's a little bit of a tension about who's, the tug of war about what the post-COVID environment's going to look like in Australia. Are we still working from home? Are we still, avoiding the inner cities or the crowded spaces in favour of these lifestyle areas? There's a bit of a tug of war there.
Yeah, remains to be seen. So, all right. Well, yes, a lot going on, but overall, so still very hot near term, cooling off later. All right. Well, thanks very much for joining us, Matt.
Thank you.
Thanks for watching, and we'll speak to you next week.